As a shareholder of a given company, I would be concerned about where the stock price is going to go, for I would either be making a loss or a profit. But why do companies care so much about their stock prices? This is a question many of us would have often wondered. Well, here's the answer. It all comes down to four main reasons. The first being companies also hold shares of their own company, which means if their company's share price goes up, the value of the shares they hold would also go up. Now, this means a lot to a company, as they usually hold quite a big chunk of their own company share, usually around 30 to 50%. And for a mid-sized company, which has an equity of around 20,000 crore, that is 10,000 crore worth of shares they are holding. I'm pretty sure if anyone is holding 10,000 crore worth of a stock, they would be very much concerned about the share price in the stock market. Now, the second reason is, usually a big part of most of the top executives' salaries are paid in stocks of their own company. For example, for Apple CEO, Tim Cook has been paid $98 million for the year 2021. Out of which only $3 million is the actual salary. Remaining $82 million is being paid in form of Apple shares, and $13 million in other form of compensation. Now, the shares make for a big part of their salary, and even if he want to sell his $82 million worth of shares and cash it out for a higher salary, he just can't, as most companies have a lock-in period of 3 to 5 years before they can sell their shares. Now, that's a good thing, since most of the top executives are holding a big part of shares of their companies. The executives would want their share prices to go up. Hence, they would perform more sincerely for the betterment of the company, which would improve the company's performance, therefore improving the view of the company in the investors' eyes, resulting in the stock price going up. The third reason why a company would care about their stock price is financing. Now, apart from raising finance through initial public offering, a company further down the road raise even more capital through equity financing, which is the process of raising capital through the sale of new shares. However, for this to happen, the company must demonstrate a healthy share price in order to project an attractive outlook to potential new investors. Also, companies should be careful not to overissue new shares, because an overabundance of shares circulating in the market may diminish demand, where there's simply not enough buyers to gobble up the shares, which could ultimately depress the stock price. Moving on to the fourth point. Takeovers are another reason why the management of a public company would be concerned about its share price, such that if a company's share price is falling at a rapid rate, it would mean that the company would be more likely to be acquired, as the share would be much cheaper and bidders would be better able to make offers to shareholders. This is especially so for companies with shares which are widely held as opposed to closely held. Although these 4 points that I have spoken are the main reasons for companies being concerned about their stock price, nevertheless, there is yet another aspect, which is simply ego. Where the culture is such that each person is trying to outdo the other, it is seen as prestigious to have a share price that is strong and also one with soaring growth potential. Hope you found this video useful. Many more trading and investing videos on Wealth Trader. Hit the subscribe button to stay tuned.